welcome back to my channel. So today's video is all about understanding the put to call ratio. I'll start off by explaining it. I'll provide examples on how to read the PCR in Thinkorswim, and of course I'll also go into detail about how to become profitable from analyzing it. So to start, the put to call ratio is a long-standing metric in options trading, probably one of the oldest measures of market direction. It's calculated by dividing the total volume of put options by the total volume of call options within a given period. And high ratios often precede rallies as markets overcorrect on the downside, while low ratios can be a warning of market complacency, signaling potential drops. How it works is, when put and call volumes are equal, the ratio is 1.0. If twice as many calls are traded compared to puts, the ratio is 0.5, because a lower ratio below 1 indicates a bullish outlook due to higher call volume. The opposite is also true. If puts have twice the volume of calls, the ratio is 2.0, so with a higher ratio above 1, this suggests bearish sentiment due to more put activity. Now, volume increases confirm the conviction behind an intraday put or call shift. If a sharp increase in put volume aligns with a high total volume of the underlying stock, it suggests a strong downside. Along with that, a high PC ratio with heavy open interest in puts suggests that traders are preparing for a sustained downtrend, while low open interest could indicate short-term positioning rather than deep commitment. Now, these factors serve as signals. Hence, understanding the PCR as a measure of the volume of put options relative to call options means interpreting that a higher ratio signals more put buying, often associated with rising caution in the market. So typically, when put options outpace calls, the market is bracing for potential drops, often triggered by uncertain events or specific catalysts, and I'll talk more about that in a sec. But traders usually view a high put to call ratio as a clue that panic may be pushing prices down. Some even interpret extreme levels as an opposing signal, meaning that strong fear could precede a bounce. Now, on the other hand, optimism causes a lower ratio, which then indicates more call buying, reflecting confidence in upward movement. If calls significantly outnumber puts, it suggests that traders are expecting a continued rise. However, excessive optimism can also lead to corrections as overextended markets eventually have to reset. So basically, to put this plainly, the PC ratio is used as a determination of market sentiment. However, y'all have heard me say before that options volume alone may not reliably signal directional bias as a single means of measurement. So it is a good indication, but it shouldn't stand alone as the only means of a determining factor. And because of that, similar to indicators like volatility and the Sizzle index, I often combine the PC ratio with technical analysis indicators like moving averages or the evaluation of breakout levels to add context to the market outlook in totality. Now, in reference to the volatility measures, the option stat page in TOS focuses on volatility measures, both historical volatility and implied volatility, showing how current levels compared to levels from the past year. So you would use the PCR alongside broader indicators like the VIX, which is like the volatility index, and sector indices. So for example, if both the PC ratio and VIX are high, it could provide insight to support the likelihood of a reversal. But if only the put-call ratio is high, but the VIX remains steady, it might reflect a temporary hedging increase rather than being sustained. So I hope that's pretty clear. Now, I use the Sizzle index to identify unusual options activity by comparing a stock or ETF, its current options volume, to its average daily volume over the past 5 trading days. And pretty much the Sizzle index will tell you if it's above 1, the signal points toward the current trading volume exceeding the recent average, while viewing it below 1 indicates lower than average volume. So for instance, let's say you see a sizzle of 4.0. This would mean that there's 4 times the usual volume, which would clearly make you stop to pause to look at what's confirming the trend, whereas a 0.5 would reflect half the average volume. The reason this is important is because observing highs in the Sizzle index can sometimes, only sometimes I'll say, indicate momentum behind the stock's movement. A sharp increase during a significant price swing might also suggest the strength in that direction, while a large price move on low volume could indicate weaker conviction and even possibly a trend reversal. And I'll touch on this more in a future video because it does have some complexities that I want to fully break down in greater detail. But the main takeaway is that separate levels for calls and puts allows traders to see where most of the unusual volume is happening, which can reveal where important price levels need placement. Okay, so this chart on the screen provides a visual explanation of how the metrics of a put to call ratio can indicate potential market direction and sentiment shifts throughout a trading period. So we can see with this example, the market opened with high momentum of the stock, so the price rose briefly. This is followed by competition among buyers and sellers, which placed the stock in a consolidation phase for a moment. From there, the stock rose up, showing more buying power. Following this, the seller stepped in, and this is where the chart shows a rise in the put to call ratio above 1, which signifies more put option activity than call option activity. This is typically interpreted as a very strong bearish sentiment, as investors are purchasing more puts, possibly as a hedge against a market decline or other factors, because the market price indeed experiences a decrease, clearly showing the bearish phase. This part of the chart visually supports the idea that high put to call ratios can often signal market pessimism or just a high sell-off, potentially leading to a larger downtrend. Later on the chart, we see the put to call ratio falls below 1, which suggests a shift to bullish sentiment as more call options are traded relative to puts. This generally indicates investors regain confidence in a potential market upswing as the stock price reverses and begins a rally. This part illustrates how a low PCR can indicate rising purchasing power, with buyers more willing to take on risks, potentially driving prices even higher. So essentially, this chart demonstrates how the PC ratio can serve as a determinant indicator, with high values often preceding downturns and low values signaling potential rallies. So monitoring heightened levels in the ratio will always help traders anticipate shifts in the market. Okay, so next up, I want to briefly mention the PCR symbols in thinkorswim. And of course, I'll show you what this looks like on the charts momentarily. But to start, P-call will provide the ratio for all listed stocks. PCI will tell you the ratio for the Dow Jones. PCRL provides the ratio for the Russell 2000. PCSP lists the ratio for the S&P 500. And then, of course, PCND will show you the ratio for the NASDAQ. So I wanted to elaborate on this because you certainly want to adjust the symbols based on the index. For example, if you're trading SPX or SPY, then it makes perfect sense to view the ratio PCSP. Not saying you can't view it on P-call for all stocks, but it's also best to get a specific viewpoint set for the indices that fall under the stocks or ETFs that you're actually trading. So because of that, let's dive into thinkorswim so I can show y'all the setup. Okay, so I have NVIDIA pulled up here on the chart. So of course I'm just going to show a quick example so you guys can see essentially what this looks like. Let me pull up a chart underneath. Of course, P-call is going to tell us the overall put to call ratio for the sectors. I'm going to drop this down to the 1 minute just for example purposes. And then of course I'll zoom it in so you guys can see. Okay, so essentially to look at the PC ratio, you're going to definitely make sure you're taking a look at where it is currently. And again, this is for all ratios for options. So you can see it at a 0.63 at the time of filming this video. So again, this is going to tell you overall market sentiment. Let's say I'm going to go ahead and change this. Let's say I want to pull a SPY, for example, or SPX. At this point, I'm going to go ahead and zoom it in as well so you guys can see. And then I would change P-call to PCSP so that you can see it on the S&P 500. This is important to note because you want to take a look at the specific index that you're trading, and in this case it's SPY, SPX. So you're going to look for those correlations to see if anything makes sense for the volume that you're looking to trade for, or if your trading plan is going to correlate with what you see as far as the put to call ratio. So again, this is one of those things where you can just evaluate. So we see currently for the S&P, the PC ratio is currently at a 0.53. Again, this is something just to keep in mind. Now you want to evaluate this based upon what you see fit and also combining this with other elements. So if you want to take a look at it throughout the day, you definitely can. Adjust it for what makes the most sense for what you know you want to do, and of course to meet the goals that you're trying to set for yourself, and also to meet those profitability targets. So yeah, that's just essentially how you would pull this up. And I'm showing y'all this so y'all can see various different ways to become profitable and to stay profitable. Just make sure you're monitoring specific target areas. Anything that you feel is relevant and important for you, go ahead and move forward with that. Not to make this too long because I know that can be kind of, drawn out. I just wanted to provide this to show you guys this is how you would pull it up in Thinkorswim. Now, I'm not exactly sure how you would get to this information in things like Webull, and I know some of y'all use Robinhood. I don't know that they offer this particular function, but if they do, I'm sure it's kind of the same way to pull it up. So yeah, that's pretty much how you would do that in Thinkorswim. Y'all let me know if y'all have questions on this. I can go into more detail, but again, it's pretty straightforward. Okay, so now I definitely want to discuss the content breakdown on how to use PCR for profits. First, let's start by looking at it from a macro level. From this standpoint, the reason why the PCR matters is that by watching the put to call ratio, traders keep a benchmark on the market's emotional state and adjust their strategies based on the prevailing outlook. Some of the macro factors are things such as major economic events, Fed announcements, inflation data releases. All these things can influence market-wide sentiment and distort the put to call ratio in a real way. These events often lead to widespread hedging activity or speculative trades, which can temporarily elevate the ratio in either direction. A low ratio during an optimistic macro period doesn't necessarily signal complacency because it may just reflect a generally positive economic outlook. Now, in regards to breaking down the levels based upon expiry ratios, the full scope view is a powerful indicator because it provides an undivided perspective on how investors feel about the overall market, individual stocks, or the entire sector as a whole. Because the overall PCR not only reflects a stock's mood, but also highlights whether investors lean toward caution or confidence in that particular stock, when tracking the sentiment for an individual stock, a high PR ratio can be objective and increase bearishness even if the general market sentiment is neutral or bullish. So, with that being said, identifying outliers where the sentiment diverges from the broader market can spotlight potential breakout opportunities, and typically these breakouts can be sudden and sharp. So, if you catch the numbers fairly quickly, and let's say you enter into a trade, granted with it being high probability and paired with other indicators, you can stand to make considerable gains when the timing is just right. Additionally, the point of view within specific sectors can guide traders in sector rotation strategies. So, this means by focusing on the PCR for, let's say, ETFs or key stocks in a particular sector, investors can determine interest in high growth areas. For instance, if sentiment shifts towards defensive sectors like utilities or energy, it might indicate a trend toward risk aversion. Conversely, high optimism in like the tech or financial sectors often points towards a growth-oriented sensibility. And even better than that, evaluating the PC ratio by sector can provide swing traders with opportunities for rotational plays. So if a particular sector's ratio heightens while others are neutral, take every opportunity to play this to your favor, and I'll touch on this more in a sec. But because different sectors experience unique pressures, without considering sector factors, interpreting the ratio as a buyer-sell signal could lead to mistiming trades, so it's good to do at least a little bit of research beforehand. Now, another element to this is analyzing ratios across different expiration periods because this adds depth to sentiment analysis as well. Weekly expiration ratios give clues into immediate short-term motion, helpful for spotting short-term shifts or quick reversals. Meanwhile, monthly expiry ratios reflect deeper conviction among longer-term investors and their long-term positioning, which can reveal the underlying market outlook on some like behind-the-scenes type analysis. So combining these periods also allows you to refine your understanding whether sentiment is a fleeting reaction or part of a larger trend. And that's helpful because analyzing weekly versus monthly put to call extremes can also enhance your trading strategy. Combining this awareness, especially if you're a new trader, helps to improve entry points and align with either short-term reversals or longer-term continuation patterns. Next, you may also want to find extreme levels to help with processing your trades. You can monitor extreme put-to-call ratios to catch overbought or oversold conditions, which then can also give you a clue for a turnaround or a continuation of trends. So just keep in mind when the ratio is unusually high for put options, this suggests that the market is oversold. So the best way to interpret this is as a potential bottoming signal and I always anticipate a reversal since it's too bearish, suggesting that the market may be overcorrecting on the downside. On the other hand, when the ratio is excessively low, it tends to signal that the market is overbought, potentially preceding a correction as the sentiment becomes too bullish. Now, here's how this strategy works for me. I personally use some historical insight on how it has impacted the market moves to catch momentum shifts and avoid overextended moves itself. So, real quick, just as a reference, some historical examples of extreme ratios leading to reversals are 1. The 2008 financial crisis. As the market was falling, the PCR hit extreme highs multiple times, reflecting massive fear. These peaks in the ratio were closely followed by short-term rallies as overly bearish sentiment shifted briefly to short covering and temporary buying. This was similarly true during the 2018 market correction. I had to research this myself, but some of y'all may actually remember in December of 2018, there was a market correction and the put to call ratio soared as investors hit new highs, which was followed by a powerful January rebound when oversold conditions attracted significant buying. So just by me studying the charts and reading up on the history of how the market behaves, I was able to pick up on these things to see an overall pattern. Now at this point, you may be thinking, what are some of the tools for catching extreme sentiment shifts? Well, one is to use real-time option scanners to monitor PCR across different time frames and assets. These scanners can alert traders to unusual options activity, such as sharp increases in put or call volumes that might indicate the shift in sentiment, or to see when major investors spend significant amounts of money at one given time. And remember, you can customize these sentiment indicators that aggregate options volume data for the whole market or for the specific sectors of your choosing. For example, some traders set alert thresholds for the PC ratio, where crossing a certain level triggers a watch for potential reversal setup so that they can enter a trade without having to spend hours just monitoring the charts. Now, platforms like thinkorswim or TradingView offer market sentiment overlays that you can use to spot your desired levels, which really just makes it easier to analyze the overlay ratios with price action and other indicators for validation. So an entry tip for bullish plays is to look for high PCR paired with volume and a positive MACD crossover. And that's when the MACD line crosses above the signal line. If the volume surges, showing a climax of selling pressure, while the MACD crossover indicates shifting momentum, both are a good clue to go long on a bullish entry. The exit tip I have for y'all is to watch for a low PC ratio in conjunction with price hitting a key resistance level and a negative MACD crossover. If you see these alongside fading volume, it can be an optimal exit point as momentum weakens and a reversal or consolidation is likely to soon come. When using the MACD for timing, the crossovers are pretty reliable as they show the true momentum shifts. When an extreme PCR aligns perfectly with the MACD crossover, the odds of a successful entry or exit increase, giving a clearer picture of the influence on price action. Now, my best strategic tips for combining indicators with the PCR is to first confirm direction with volume, because you ideally want to see where the stock reaches a peak. Volume spikes add credibility to the sentiment signal, showing that large players are active. And also using the moving averages for trend confirmation. When you pair that with the PC ratio with the moving averages like the 50-day or the 200-day, this helps determine if the sentiment extremely aligns with the broader trend. For instance, a high put to call ratio and a bullish move above the 50-day moving average can confirm a trend reversal and a good entry point. Alongside that, the RSI is a good compatible indicator for confirmation as well. If the PCR shows an extreme level, I would say check the RSI for further validation. A good example of this is if both the put to call ratio and RSI are in the oversold territory, it even further increases the likelihood of a reversal. Whereas a low PC ratio with a high RSI, those values can signal overbought conditions, supporting a reason to go short or exit a trade completely. These indicators help confirm the extremity of a change in the direction, so just use your best judgment, especially when aligning with the support and resistance levels, since the high ratios are more actionable when they align. It's necessary to evaluate this in order to avoid the pitfalls of relying on this metric in isolation. So using these combinations allows for more than just a sentiment indicator. It's really a timing tool that provides more concrete entry and exit cues. So speaking of timing, next up is addressing using the PC ratio on an intraday basis to allow for the recognition of shifts in momentum with precision. This is particularly valuable in volatile markets or when trading shorter time frames, because intraday heights in the PCR can be rapid, as mentioned, and those sudden increases mean you should consider the time horizon. So in reference to that, it's good to know that intraday highs and lows with the PCR will suggest a yielding point. So if you see surges in put volume or if you see surges in call volume around key support levels, this can serve as a hint that the market is overly bearish or bullish and can soon rally or reject at this particular level. So that's why smart money positioning is key. So let me give you an example. We see the low for the day was at 594.37 and that's at 1201. So when we come down here and look at that PC ratio at 1201, we see it was at a zero point 0.5. Now remember, a zero point 0.5 tells us that there's twice as many calls traded as puts. So what happened essentially after this? At 12:02, we see this extremely bullish candle, and I'm going to zoom it in so you guys can see exactly what I'm talking about. At 12:02, we see this extremely bullish candle, and that lets us know that the market sentiment has now shifted. Essentially, that zero point 0.5 at this 12:01 mark would give you a clue. Now, it was hovering around this essentially prior to, so it wasn't a perfect way to measure it, as you guys can see, but it does give you an indication and a clue. So it's one way to just kind of combine this with other indicators as mentioned to essentially have a setup that makes more sense. So when smart money players are preparing for a downturn, potentially due to unreleased news or any economic data, positioning can act as an early warning for traders, especially if the put volume increases alongside a steady price level rather than a rapid drop, due to the anticipated news as adverse to simply a reaction to it. So that's why I wanted to pinpoint things like this. Now, granted, this wasn't a day for a whole lot of news to have dropped, but again, it's a good indication to let you know when you combine it with other indicators that you could be onto the right track with measuring your trades accurately. So all in all, in intraday entry points, when the put volume spikes without a corresponding sharp price drop, this can signal hidden or unseen caution in the market. So that's something to pay attention to, especially those who are new to trading. You may not spot it offhand. If you're considering a bullish trade, it might be wise to wait for the rise to subside, as it could tell you that those smart money investors expect a correction shortly. So again, patience is always going to be key. Now, in reference to intraday trends and swing trades, monitoring the PCR shifts around VWAP is beneficial because this can pinpoint a good setup. Because of that, if put volume rapidly increases as the stock or ETF hits the VWAP from below, it suggests that sellers are defending that level, making it a likely short setup. Swing traders, on the other hand, benefit from analyzing multi-day trends in the ratio, allowing to enter and exit on alignment with wide-ranging viewpoints of the extremes. So that's something to always keep in mind. When swing trading, you can look at the daily or weekly PCR trends from any time of measure, whether it's 60 days, 90 days, 6 months, or whatever you're comfortable with to understand extensive sentiment and position your trades for the medium-term moves, because it can act as a real-time barometer, which is ideal for accurately timing those positions. Now, for confirmation purposes, a persistently high daily or weekly PCR may signal that bearish sentiment is much too extreme, and chances are that it will reverse sooner than later. So when swing trading, watch for this signal in conjunction with price support levels, viewing it as an entry point for a long position over the long run, but it's good not to be complacent when evaluating these levels. You may decide to use the PCR to confirm momentum during trending markets. For example, if the market is in an uptrend and the put to call ratio remains neutral or slightly bullish, it shows stability, supporting continued momentum. However, if the call volume becomes excessively high, this could hint at an overreached rally, which I spoke on, and this signals that it's the best time to take profits. Now, to address any misinterpretations, not every high or low put call ratio is a straightforward buy or sell signal because context matters greatly. Several external factors can influence these levels, and interpreting them without understanding the broader circumstances can cause misleading conclusions. So it's essential for factors like seasonality and earnings to play a role. As a general notion, the market typically experiences seasonal patterns with certain months like October or January known for higher volatility. During these periods, high put volumes may reflect broader seasonal caution rather than impending downturn. For example, October is historically a volatile month every single year for the most part because of the bounce back of the stagnation from September, and a high put to call ratio may simply indicate traders are bracing for this. Also, around major holidays like Thanksgiving or Christmas, trading volumes can drop, which may skew the PC ratio. Low ratios during these times might not necessarily signal complacency as well. Instead, they could reflect fewer active traders and lighter positioning across the board. The last thing on this is that pre-earnings hedging is often an element as well to consider. During earnings season, companies often see a rise in either put or call volumes as traders hedge against the potential earnings surprises as reports are released. A sudden increase in put options ahead of earnings isn't always a bearish signal either. It might just reflect cautious positioning by investors to manage risks accordingly. Most investors are aware that post-earnings adjustments after an earnings report show sentiment may shift quickly, which can cause temporary fluctuations in the PCR. Traders might close out positions rapidly, leading to a low or high ratio that doesn't necessarily indicate a broader trend, but rather a reaction to a specific financial discovery on the report. That leads to the seventh and final point of historical analysis. I'll mention this to add more understanding on how interpreting the PC ratio can lead to profitable trades. So let's look at some examples over the last few months where the key shifts in the ratio were aligned with significant market moves. In late July of this year, the S&P 500 experienced a sharp correction with the put-to-call ratio reaching a 1.49. I remember this specifically because that was the signal for a bearish sentiment for me. Alongside this extremity, the VIX index rose as well, indicating increased fear in the market. Together, these indicators suggested a potential oversold condition, and investors entered long positions during this period. They saw profitable rebounds as the index bottomed out and later rallied by early August. Such high readings on the put-to-call ratio, especially when confirmed by rising VIX and the skew index levels, have historically signaled market bottoms due to a buildup of protective puts, which often precedes a recovered rally, which we have seen time and time again. This past September, a similar spike occurred, again with the put-to-call ratio climbing above 1.3. Coupled with an increase in the skew index, which reflects the tail risk, this setup indicated that a large part of the market was preparing for a potential downturn or sharp volatility. Those who interpreted these signals correctly and placed protective or speculative put options were positioned to profit during the market's short-term dip. And then last month in October, the S&P 500 saw a recovery. After another market correction, the put-to-call ratio was high once more. Following the earlier sell-off, this pattern allowed traders to spot another buying opportunity as the market rebounded shortly afterward. By incorporating the VIX and the skew index once again, traders had confirmation that the market might soon reverse its downtrend, creating a profitable entry for long positions. Now, these examples just illustrate that the PCR becomes especially useful when the sentiment levels peak, as overreaction to outlooks can create opportunities for market rebounds. So such strategies are best paired with your own trading plan when officially validated. And this just helps to pinpoint and justify your actions when spotting overextended bearish and bullish standpoints. So the last thing I want to mention in this video is that to effectively analyze and interpret the PC ratio, I do think it's a good idea to consider using Thinkorswim or TradingView's tools for those full overlays. And for practice for new traders, you can try creating a watch list of like 5 to 10 stocks across different sectors on your chosen platform. Observe the daily and weekly PCR, noting when the ratios reach extreme levels, so anything like above 1.2 for heavy put activity or below a 0.7 for high call interest. Watch how these levels align with price movements and other indicators such as volume increases before applying analytics in live trades. So with that being said, you can start tracking put-to-call ratios on the sectors or stocks you specifically trade regularly. By observing these ratios over time, especially during major news or economic events, you'll start spotting patterns so that can help you time entries and exits perfectly. So yeah, I recommend just trying it out to help refine your edge with real-world data, just to see what benefit it serves in your trading. And with that, that'll pretty much do it for this video. Y'all feel free to let me know y'all's thoughts in the comments below. As always, I thank y'all so much for watching, and I'll see y'all in my next one.